All right, good afternoon, folks. We're going to go ahead and get started. Again, welcome to Spring Consulting's Group's Spring Insights webcast titled Use Your Captive to Enhance Capital Management. I'd like to introduce you to the platform of today's presentation. You'll notice, the big screen in front of you, and to a left, something that's called the chat box. So if you have any questions throughout the presentation, please feel free to type that in. You won't be able to speak with us, but you'll be able to interact with us through that chat application. A little bit about today's speaker. Donald Reagan is a senior consultant and head of risk financing for the practice here at Spring Consulting Group. Don has over 25 years experience creating alternative risk financing structures as a broker and a consultant, and is an accomplished author and speaker. Don's previous experience includes alternative risk solutions practice leader at the Boston-based Albert Risk Management Consultants and managing director of product development at Liberty Mutual Alternative Markets. Don holds a Bachelor's of Science degree from Towson University, as well as the Chartered Property Casual Underwriter and the Associate in Risk Management professional designations. A little bit about Spring Consulting Group. Formerly, we were the U.S. Watson Wyatt Insurance and Financial Services Consulting Group. In March of 2004, there was a management buyout to form Spring Consulting Group. We provide strategy consulting services to employers, insurance, and financial service providers, and captive owners. Our subject matter expertise is in retirement, life, health care, including retiree medical, disability, absence management, workers' compensation, captive insurance, and strategic risk management. We're governed by a non-executive chairman and advisory board of industry experts, and we are 100% employee-owned. Recently, Spring wins Business Insurance Innovation Award for its patent, which is a patented process which enables employers to reduce the cost of their employee and retiree benefits by funding them through a captive. And without further ado, I'd like to introduce Donald Reagan, who is, again, the senior consultant here at Spring Consulting Group, and he's going to bring you on a journey through using your capital to enhance capital management.
Hello, everybody. A few comments before we get going. This is a whole lot different from other webinars that you perhaps have attended, in that you really shouldn't multitask. It's hard to be passive during this and actually get it unless you are a CFO and you work in finance all the time. Then you can read the paper. But if not, and you are interested in what this is all about, I would suggest that you pay close attention to the slides, because each slide builds upon the other. When people show up in about 10 minutes thinking that they can probably write out the rest of the webinar, they will find that they cannot, and I'll have to go back with them individually if they like. What we're going to do is you're going to learn some basic finance and introduce two new metrics based on basic finance pertainable to captives. If you have to wrap this up into one comment, one definition, it's all about capital management. And as we go through the slides, I'm going to be saying that a lot. So that's what we're talking about. And also, if any of you are very familiar with the calculations and the concepts we're going to go through, please know that these are very simple, very, very, very simple, designed to help you understand, or help those of you who don't know what these are understand. Yes, and I will say right off the bat, there are many, many, many more complex ways of using these calculations, and you'll see when we get going. As far as questions goes, I have found that a lot of questions arise, but then 2 or 3 slides later, they may be answered. Unless you have a question that simply cannot wait, I would suggest waiting until close to the end, and we can address them then. We have until 2 o'clock, so we are going to march through these slides, but only as quickly as we can, because you will see what's going on. So, and one more thing. When I do this in front of conference folks and so forth, and I do not like to read slides, but I'll tell you, you're going to read slides in this, and for good reason, and you'll see as we go along. All right, what are the session objectives? we are going to describe a method of leveraging your single-parent captive's equity to increase its value to the company, the parent company. We're going to understand how 5 financial metrics are used to translate the captive's value into a risk charge. Risk charge, which may be used to add value to every capital commitment or investment. Let's stop there and talk about a risk charge. A risk charge is a charge added to the cost of one of the components of capital. Equity has a number of risk charges, and equity is capital. So as we go along, we are going to create a risk charge for insurable risk. And you'll see how all this comes together. You notice that the slides are very, very descriptive, and they're that way on purpose. So as I talk, you'll be able to hopefully understand what's going on the slide, and then at the bottom, you'll see what we're going to do next. But here is the bottom line. At the end of this session, we are going to create a metric called the risk-adjusted cost of risk capital that can be added to a company's hurdle rate to capture the cost of risk with every capital investment. That is it. So we're going to go through a whole lot of machinations to get there, but this is the bottom line. And when we come up with this, I call it the RACR, and I shall call it the RACR, risk-adjusted cost of risk capital, throughout the session. We will be able to convert that into a dollar figure through an example at the end. All will become clear at the end. Finally, our session objectives. Before we can calculate the RACR, we have to understand these metrics. What is a hurdle rate? What is RAROC, risk-adjusted return on capital? What is the WACC, weighted average cost of capital? And then a new one called the cost of risk capital. As I say, all will become clear as we go through the slides, but you must pay attention. Throughout the presentation, we're going to be using these data, and they're from as it says, a major U.S. Public company. You don't have to memorize them here. Just know that you're going to see these come up from time to time. So let's go through the first one, the hurdle rate. And as you will be able to see when we go through this, this whole presentation is directed to those of you that have no clue what any of this is. So I assume, as always, that there is a cross-section of folks. Some are totally familiar with it, and some, as I said before, have no idea. A hurdle rate, quite simply, is the minimum rate of return required for a capital commitment, right? Like an acquisition, new product line, construction project. The thing about the hurdle rate is it must always exceed the company's cost of capital, right? And the third bullet, a company can't pay more for its capital than it earns with that capital. And it makes sense. And that's a very, so far, so good, very simple concept. So the rate you get on any capital investment must exceed the cost of that capital investment. Pretty simple so far. Here is another one. And those of you in the know on these things will see just how simplistic these definitions are and the calculations, but please try to bear with us. The risk-adjusted return on capital, RAROC. There's all sorts of different variations of this, but we're going to stick with this one. Let's talk about risk-adjusted return on capital. A company's capital is comprised of basically two things. Some companies have a bunch of other things in there. Some companies use retained earnings. Debt and equity, folks. That's it. That's what we're going to talk about here. Debt and equity. Both are invested in the business and produce return on capital. The formula to calculate return on capital is pretty straightforward. Revenues less expenses divided by equity capital. Pretty easy. The RAROC formula is the same as above, but adds a risk component expected business losses, or expected is more insurance lingo, business losses. So loss on the sale of a subsidiary, let's say, or loss because of reorganization, anything where your earnings takes a hit. Now here, again, as simply as possible, is the RAROC calculation. We have revenues, $9.9 billion. We have the cost of goods sold, G&A and interest, expenses, $9.2 billion. Expected business losses, this is an actual company, and this happens to be $72 million loss on the sale of subsidiary. And we have interest income. All of that is divided by the $6 billion of equity capital. And have a look at how we describe equity capital. Equity capital in this calculation really tries to grasp the entire amount of capital that this company would need to cover all of its contingencies, credit risk, market risk, interest rate risk, the whole 9 yards. So we express that in a confidence level. So we're saying, for the sake of argument, that this represents 95% confidence. So we have our calculation, and we go up to the top of the screen, and we see that the risk-adjusted return on capital for this company is a healthy or unhealthy, depending on your perspective, 10.77%. That is what this company is getting when it invests its capital, and it includes the losses. Okay, we have another calculation for the RAROC. But this one is a little different. It's very similar with one difference. Revenues, costs, expenses, expected business losses, and here's the difference, and expected retained insurable losses. Interest income remains the same. Equity capital at 95% remains the same. But when we include expected retained insurable losses, it drives the RAROC calculation down from 10, I believe it was 77, to 1064, because we are adding in expected retained insurable losses. Now, this is not what some of us would refer to as the TVAR, the tail value at risk. That is a lot larger. This is an annual expected losses. For large companies, obviously, workers' compensation and the P&C side is probably the best example. So our RAROC comes down. We're going to have a lot of ups and downs in these calculations, but at the end, you'll see exactly how they all work. All right. When I wrote the last two slides, I thought, all right, well, let's explain them again. You'll notice on the last two slides, one of them did not have insurable losses, and the other one did, and that is why it is lower, as we see on the next slide. And as we say, we'll come back to these a little later. But for now, let's calculate the weighted average cost of capital. And again, for those of you who are familiar with this and have done this, worked on this either currently or previously, this is a real simple approach to it, but it's simple for a reason. Okay. Weighted average cost of capital. Before we talk about weighted average, let's talk about the cost of capital a little bit, because we're going to get into it a little bit more. Capital has a cost. You cannot own equity, and you cannot have debt without paying for it, right? When we calculate the WACC, weighted average cost of capital, we're going to talk about the components of those charges, the charges that the company pays for that capital. So what's the cost of debt? It's very simple, actual costs associated with creating and issuing debt, including the after-tax cost of the debt service, the coupon that you're paying for that debt. The examples we'll get into, the numbers are not exactly realistic in today's environment, but you get the idea. The cost of equity is a little more complicated than the cost of debt. Cost of equity is, again, the actual cost associated with creating and issuing the stock, plus a risk-free rate and various risk premiums. There's that term again, risk premiums or capital charges, also known as a risk charge. Capital charges, risk charge, risk premium are paid to investors for assuming the company's risks. Now keep that in the back of your mind, and we're going to come back to this later with a much more, more of an explanation. Okay, how do we calculate debt? Pretty straightforward. All the slides with calculations are going to look exactly like this. So we have the pre-tax cost of debt for this company is $596. We go to after-tax, $388. Follow the blue arrow. After-tax cost, $388 times, and here is how we get the weighted average cost, debt divided by total paid-up capital. So in this case, the debt is $2.6 billion. The total paid-up capital is $8.6 billion. Gives us a weighted average cost of 1.17. The other part of that $8.6 billion is the equity. So we're only talking about two components here, right? Debt and equity, and that's the weighted average cost of the debt. Equity, as I said before, a little more complicated, does this. We have a share count, outstanding shares of stock of 300 million. Share price today, yesterday, tomorrow, $20. That creates an equity value, a market cap of $6 billion. Let's go below the line. We have a risk-free rate. And we say self-explanatory because it pretty much is. It's the rate that you will get regardless of what happens in the markets. Right now, I'm not sure what LIBOR is. I think it's about 20 basis points, 40 basis points, I don't know. But it has nowhere to go but up, folks, as we say. The Ibbotson risk premia. When we're done here, you could Google Ibbotson, and you will find that it is a company that keeps market records, market data, going back, I believe, to 1926. But it assigns a factor for market risk. This is the risk that you are taking in the market. And then the beta. The beta is either side of 1. So it can be 1.10, it could be 0.97, and it measures earnings volatility. But within the same, and that didn't make it on there, did you? Within the same, oh, it's way down there. Within the same companies in the same business. We're having a little practical difficulty here, folks, but we're back. Okay. Let's go to the next slide. And here is the equity calculation. All right, very similar to the debt. But we have more components here, right? We have our beta, and for this company, the beta is 115, which means that this particular company's earnings volatility is somewhat greater than the other companies in its business. And the Ibbotson, the market premium, basically, is 5.5%. We add to that the risk-free rate, and we get the total cost of equity. And again, folks, this is very simple, very simplistic. The total cost of equity, in this case, is $780. So we go on down, $780, same calculation, times equity divided by the total paid-up capital. So we have $6 billion divided by 8.6, gives us weighted average cost of equity at $544. So far, so good. Okay, so here we have total paid-up capital is $8.6 billion. And those of you that look at this every day, you will see that this is a very, very simple version of it, but it pretty much is what it is. Cost of debt, cost of equity, and the weighted average cost of capital is $661. Now we're going to introduce the cost of risk capital. This is a pretty straightforward concept, too. Risk capital is comprised of the three components that drive our professional lives in this business: premiums and all other risk management expenditures, aggregate expected retained insurable losses, and limits, what am I saying? Insurance and reinsurance limits. Just three things: premiums and expenses, loss costs, the retained losses, and the limits that you buy. This is it, folks. Now let's calculate the cost of risk capital. We have insurance limits of $1.4 billion. And I want to introduce the idea, and I'm pretty sure that a lot of you have heard of this before. Insurance limits are also considered contingent capital, right? Because you buy $1.4 billion in limits. Heaven help us if you have to, use that capital or all of it. But it is still there, and it is contingent upon an event, an insurable event. So we have $1.4 billion of limits. Premium and risk management expenses at $9 million. Retained expected losses at $7.5 million. From this, we create a rate on line for both premiums, all premiums, expenses, and expected losses, because these things are outgoing capital components. You're sending this stuff out the door. And the little note says the ROL is a rate on line is calculated by dividing the total annual premiums and RM expenses plus the annual expected retained losses by the annual insurance limits. So in this case, we have a rate on line of both premiums and losses and expenses of 1.18%. And as we say, we're almost there. Now we're going to calculate the cost of risk capital. But remember that the rate on line is, here we say it again, 1.18%. Notice the calculation is identical to the others. Pre-tax cost, 1.18, minus the tax effect, because premiums and losses, retained losses, premiums, and expenses are tax deductible. We're assuming so. After-tax cost of the rate on line is 0.77 basis points. Follow the, I was going to say yellow brick road, follow the blue arrow here. We have after-tax cost, again, 0.77 basis points, times what has become our familiar division problem here. But in this case, you'll notice that the numerator is $1.4 billion, which is the insurance limits. And the denominator is $7.4 billion, which is equity capital plus insurance limits. So just like in the other calculations, you'll remember in the debt calculation we isolated the debt amount. In the equity calculation we isolated the equity amount in the numerator. And this time we're isolating the insurance limits in the numerator. So when we do that, we have a weighted average cost of risk so far of 0.14%, 14 basis points. Now let's talk about what that means. It's kind of lead us into the rest of the slides. What that means is that along with the risk-free rate, along with the beta, along with the Ibbotson, this is a risk premium. This is a bona fide risk premium. It doesn't matter whether the fact that it resides on the income statement and the tax deduction has been taken and the money has been sent out to wherever it's going. This is the cost of risk for this particular company, 14 basis points. Okay. Now let's add this cost of risk capital to the WACC. And you'll notice that our total paid up capital plus the $8.6 billion plus the $1.4 billion brings us up to $10 billion total. So we have the CRC, cost of risk capital 0.14, and the other numbers that we calculated. So our total WACC in this case is 6.75%. Now you may be saying to yourself, the last thing I want to do is add another risk charge to the WACC. And if you don't understand why that's the case, we're going to talk about it in the next couple of slides. But if you do, you have a point. The point of this is not that you must add this risk charge to your cost of capital. The point is that you can if you want to. Few companies do. Few companies do. Let's move on. Okay. Now, folks, comes the fun stuff. Oh, it's been fun all along, I know. Calculating the risk-adjusted cost of capital, the RACR. Here's what we have. The first column, without, this is the RAROC, number 1, risk-adjusted return on capital, and the WACC, number 2, right? Without expected retained insurable losses, RAROC is 10.7. With expected retained insurable losses, that goes down to 10.64, right? That makes sense because this is a return on capital metric. The WACC, however, is a cost metric. So the WACC goes from 661 up to 675. And then we have the differences between the two, 416 and 389. The economic profit, this is the definition of economic profit, is the difference between the return on capital and the cost of capital. Insurance companies, like captives, for example, and we're going to get to this in a few minutes, captives really don't earn a profit unless they have third-party business. This is an economic profit, and many captives actually do and should earn economic profit. So far, so good. Here's what we have, and this gives us the difference between 416 and 389 is 27 basis points. Let's go to the next slide, Ed. Folks, this is the entire presentation right here. This is the purpose of why we have been sitting here for the last 40-plus minutes. The economic profit without expected retained insurable losses, economic profit with expected retained insurable losses equals, and the risk-adjusted cost of risk capital is 0.27, 27 basis points. Risk-adjusted because we have incorporated the effects of the return, the RAROC, risk-adjusted return on capital. So it takes us from 14 basis points up to 27 basis points. Now this is the number that you need to remember, which you're going to be reminded of, as we go along. 27 basis points. Okay, I'm going to back up some and talk about this stuff in English. The RACR is the cost of the company's insurable risk expressed as a charge against equity. Put another way, it's a risk charge, similar to the beta and the Abatson in the cost of equity calculation. You notice I'm reading these slides because the slides say a lot more than I could without reading them. Risk charges indirectly compensate the company shareholders for assuming the company's risks because they increase the WACC, right? Thus ensuring that the company must earn return on capital that is greater than the WACC. Now, how cool is that? This is all very simple, but this is the underlying rationale for risk charges. They're also called premiums, risk premiums, because they increase the WACC, therefore the company's hurdle rate, the company's return, however they characterize that return, whether it's hurdle rate, whatever it is, has to exceed their cost of capital. And if their cost of capital is not portrayed correctly, then they will not be getting what they need to cover their cost of capital. Now we're going to talk about the captive opportunity. This is what we're driving at here. What can we do with this RACR? I wish I could come up with another acronym for it, but it sort of applies. You can add it to your company's hurdle rate when evaluating strategic capital commitments. We have an example as we go down here. The captive opportunity, realize the difference This is another way of saying this. You realize the difference between what the company charges for risk and what the captive needs to assume it. And if you could keep that sentence in the back of your head as we go through the examples, you'll see exactly what we're talking about. Oh, no, we went too far. Yeah. Okay, we have a case study. Wait a minute, no, we just had this one. Go to the next case study. All right, don't pay no attention to that man behind the curtain. Okay, case study. I'm going to again read this to you, so follow the bouncing ball. Big development company is acquiring another developer, Little development company. Little owns 300 shopping centers, bringing Big's total holdings to 700 shopping center locations, whatever. Big has decided to cancel Little's general liability insurance program, saving a $2 million premium, and that was accounted for in the sales price, and absorb the first $1 million into its captive, appropriately named Big Cap Limited. Okay? And here are a bunch of numbers and metrics that most of us should be familiar with. We have Big Cap Limited, and this is no acquisition. This is just what Big Cap Limited looked like before the acquisition. General liability, per occurrence retention of $1 million. It has net earned premium of $58 million. Excess insurance cost at 12% of gross written premium. Variable expenses at 22% of gross written premium. Variable expenses are front fee, taxes, and everything like that. And a pure loss ratio of 35%. Here again, folks, this is just an example. That probably should be higher, but there you have it. Into the equity piece, we have share capital at $2 million. We have retained earnings at $25 million. So that means we have total equity of $27 million. The key to this is the very last number, the premium to surplus ratio. In this case, is 2.15 to 1. 2.15 to 1. You don't have to write it down, but you might, but we repeat it here. So, and here are the rough details of this acquisition. Big development company's capital contribution, or capital commitment rather, is $300 million. And because rates are so incredibly low, they decided to use it all in debt. And it's also done that way to simplify the example. Their hurdle rate plus, I'm getting ahead of myself, their hurdle rate along with its return period is 10.77%. So if we were to go back and remember what their WACC was, it was 6 and change. Their hurdle rate is 10.77, which means that everything that they invest in, every capital investment must earn at least that. So now we introduce the risk-adjusted cost of risk capital at 0.27%, 27 basis points, and the hurdle rate plus the RACR becomes 11.04%. Pretty simple so far. Okay, continuing with the value of the acquisition to Big development company. Their investment return from this was, what a coincidence, 11.04%, driven up by the 27 basis points of the RACR, less Big's weighted average cost of debt, right? Because they borrowed all the funds for this thing, just to keep this simple. Their weighted average cost of debt is 1.17, so the effective return with the risk-adjusted cost of risk capital is 9.87%. Pretty straightforward stuff. So 9.87%. Now we're going to see how that plays out. Here's the way this plays out. We have with the RACR, we have standard, which is without the RACR, and we have the RACR. The investment, $300 million under both. And this is a quick spreadsheet of the return at these two interest rates, effective return, 987 and 960, which gives us our 27 basis points risk-adjusted cost of risk capital. So as we go down the line, and I have this in red, but only to show that it's a big number. We go down the line, and the value created by including that 27 basis points in this transaction is over $5 million, $5,372,000. So that is what the captive is producing. And you may be saying to yourself, well, how is that possible? Well, friends, we're going to tell you. It's always fun when I do this in person because I get a lot of boo birds saying, yeah, you're nuts, Reagan. You're nuts. Here's how it works. Let's go back to Big Cap Limited. This is the captive for big development company. But in this picture, we have done the acquisition for years 3 through 5. So years 1 and 2, no acquisition. Years 3 through 5, we did the acquisition. And here's what happens. Insured line stays the same. Per occurrence retention stays the same. Net earned premium stays the same because we're not adding any additional premium. Annual excess insurance costs. Years 1 and 2, 12% of gross written premium. Years 3 to 5, 13% of gross written premium. We had to buy some excess because of the acquisition. Average pure loss ratios go from 35% to 45%. 35 in years 1 and 2, and 40 in years 3 to 5, because the acquisition is causing some losses. Share capital remains the same. Our retained earnings has gone down because of the losses. Very simple example, which gives us total equity of $23 million. When we do the exact same calculation as we did pre-acquisition, we get, and this is the biggie, premium to surplus ratio of 2.5 to 1. So we've gone from 2.15 to 1 to a 2.5 to 1 by adding little development companies' risk to this captive. We have not added premium and we have not added capital. We have just driven up the premium to surplus ratio. Which is pretty much what this slide says. No additional premium or capital. The captive absorbed the risk. Greater surplus utilization. I don't know about you folks, but I don't think I've met a captive that isn't, well, somewhat overcapitalized for a lot of reasons. A lot of underused or underutilized capital. Marginally higher losses in years 3 to 5, that's to be expected. And as we said before, lower retained earnings. But most importantly, this creates, out of this acquisition, $5.3 million that would not have been created but for the application of the risk-adjusted cost of risk capital, 27 basis points, to the hurdle rate. Mine went away. Oh. Okay, let's talk about some of the ramifications for the deal and see why this makes sense. The target, its GL risks pretty much mirrored Big's. So we have a similar risk profile, which is why the losses only increased marginally. The cost of Big's insurable risk, in this case, is embedded in the transaction, right, and helps drive down the total cost of the acquisition. And most importantly, as far as I'm concerned, the captive assumes a new and valuable role in the parent company's financial planning. Instead of doing its wonderful job of providing competitive insurance and being an asset that grows over time and can, help to separate the big from the commercial insurance markets over time, it also can step in and play a part in Big's capital management. So we're coming back to the whole idea here, people, of capital management. And here's some provisos. big captive, big cap, its existing surplus must have redundancy to be able to absorb the additional risk without exceeding these ratios. And these are considered safe solvency ratios: premium to surplus, surplus to retention, and reserves to surplus. So these are pretty much generally accepted safe ratios. Okay. Now let's take a breath and backtrack and see what we've accomplished here. Using the company's using the company's risk-adjusted return on capital, its weighted average cost of capital, and the three components of risk capital, right? Premium and expenses, retained losses, and insurance limits. We calculated two new risk-based metrics: the cost of risk capital, which we use to get to the risk-adjusted cost of risk capital. And as I've been saying all along, the RACR is a risk charge, identical to the beta, and a Dotson. We have an extra bullet in there. Risk charges in the WAC. This is not anything but that. This is a capital risk charge. Continuing with what we've accomplished, we've added this risk charge, in this case 27 basis points, to the company's hurdle rate, just as risk premiums are added to the WAC to accurately reflect the risk borne by the shareholders. And you'll recall that risks are necessary, risk charges are necessary in the WAC so that the shareholders know that the company's return metrics, return on capital, including the hurdle rate, exceed the WAC, which they must. And finally, well, we have a couple of more of these. Now that we have our RACR and increased hurdle rate, any new capital investments returns must meet or exceed the new hurdle rate, producing additional returns based on the risk-adjusted cost of risk capital risk charge. Then we place the new risk, or whatever it is, acquisition into our captive. We do not increase premiums or capital, assuming, as we said a few slides ago, that the captive has enough capital to be surplus to be able to absorb these risks. So what we're really doing here is we're coming up with a bona fide way of calculating the captive's value to the company, to the parent company, in a whole different way, in a way that affects capital, in a way that affects the company's capital management. So here's what's happening with the captive. Expected effects are higher loss ratio, yep, because you have more risk in there, lower retained earnings because of higher loss ratio, and a higher premium to surplus ratio. These are the three things that happen inside the captive. And the last bit on this slide is probably the most critical comment that I can make about this. As long as the captive can absorb the changes, which we model at the onset, because we're not going to go through this process without knowing that the captive has some flexibility relative to its surplus, i.e. a lot of surplus, then we can do it. Then we're good to go. But if we find that there's not enough capital to do this, then it does not make sense, because you would have to add capital to the captive and probably premium to the captive to accommodate the risk that you're putting in. So there you have it, folks. I'm sure now you understand why I implored you to pay attention to the slides. If we have no questions now, or if we do have questions, we have a few minutes, I'm certainly willing and ready to get on the phone or through email and talk about these things with you. I would welcome the chance, actually. We've used this in two separate instances before with very good results. And it's some fun stuff.
Yeah, folks, what we want to do right now is we just have this quick survey to ask you if you currently have a captive. It just allows us to, in the future, frame our webinars to the appropriate audience. A few more minutes for people to answer, and the chat is also open too as well if you have any questions for Don.
How can we get copies of the slides from this presentation?
Okay, that's actually a great question. This presentation has actually been recorded, so preceding this, we will be sending out a link in the next 24 to 48 hours where you'll be actually able to review the presentation and slides again as well as the audio. So that will be coming to you through email. All right, great. Well, again, we appreciate the time that you were able to share with us today, and in the next 24 to 48 hours, we will be sending out the link so you can review this presentation. Thanks a lot, folks.
Thanks, everyone.
Thank you. Please stand by.